Hi there. In this video, we explain how 455 tax refunds work, when Form L2P can be submitted, and why timing matters for UK directors.
Imagine sitting down with a cup of coffee, looking over your company accounts, and suddenly realizing that HMRC is holding over a third of your hard-earned cash. And the kicker? It's all because of a loan you took from your very own business. Seeing a number like that trapped on a balance sheet is, quite frankly, a real shock for a lot of business owners. Welcome to this explainer prepared by Atlas Tax Advisors. We're a premier UK accounting firm dedicated to helping businesses absolutely master tax compliance and navigate HMRC regulations. Today, we're unpacking the highly specific and, let's be honest, often frustrating timeline for reclaiming trapped Section 455 tax on directors' loans for the 2026/27 tax year. If you're a UK director of a small limited company, grasping how this works is absolutely crucial for protecting your cash flow. Right, let's start with the big one, 35.75%. Take a moment to just let that figure sink in. This is the hefty tax rate your company faces if a director's loan isn't cleared within 9 months of your company's year-end from April 2026 onwards. You see, it's pegged to the dividend upper rate, which means we've watched it climb significantly over the years. And make no mistake, this isn't just a minor administrative penalty or a slap on the wrist. It is a massive chunk of your working capital that suddenly gets tied up in the HMRC system. It can literally cripple the cash you have available to actually run and grow your business.
So, is your company's cash currently trapped at HMRC? For many UK directors, having over a third of a loan balance stuck out of reach is incredibly painful. You know how it happens. You take the money out, maybe to cover some unexpected personal expenses, or maybe to fund a short-term project, fully expecting to pay it back. But life gets in the way, the clock runs out, and now that cash is just sitting with the tax man. But here's the vital thing to remember. This is a temporary tax. The money isn't gone forever. Understanding the exact rules and the very strict timelines is the key to unlocking that vault and getting your cash back into your business where it belongs.
Today, we're going to map out this complete journey for you. We'll be looking at 1. The Section 455 tax trap, 2. Clearing your director's loan, 3. The 9-month waiting game, 4. Submitting your reclaim form, and finally, 5. Avoiding common tax pitfalls.
Let's jump right into Section 1, the Section 455 tax trap. To get out of the trap, we first need to understand exactly how it's set. Section 455 of the Corporation Tax Act applies to what HMRC calls close companies. In plain English, that's essentially most small family-owned or director-controlled limited companies in the UK. If you take a loan from your company and you don't repay it within 9 months and 1 day of your accounting year-end, well, that's when HMRC steps in and levies this 35.75% tax on the outstanding balance. And to make matters worse, this charge is payable right alongside your standard corporation tax bill.
Now, the good news is that you absolutely can get this money back. However, this is something many taxpayers first discover when reviewing their tax position, and it's a bit of a shock. HMRC holds on to that money until the loan is fully and officially dealt with. It is not an automatic refund. You have to take proactive action, and you have to play entirely by their timeline. The tax might be temporary, but the wait is very, very real, and it is heavily structured.
Moving on to Section 2, clearing your director's loan.
Before you can even think about reclaiming a single penny of that 35.75%, you must officially clear the outstanding loan balance. You essentially have 4 main ways to do this. The most straightforward, just repay it directly using your own personal cash. Alternatively, your company can vote a dividend to you or process a salary bonus, which is then officially offset against the loan balance. Finally, the company could choose to just write off the loan entirely. But beware here, if you use dividends, salary, or a write-off, you are going to trigger personal income tax liabilities. Each of these methods leaves a very different tax footprint, so it requires some careful planning with your tax advisor. A lot of people overlook this detail, but it's a real lifesaver. Here is a professional tip straight from the team at Atlas Tax Advisors. If you are clearing the loan via dividends, you must ensure your board minutes and dividend vouchers are correctly dated. Keeping crystal clear records is absolutely essential, because if HMRC investigates and your dividend documentation is missing or looks like it was hastily backdated, they will argue the loan was never legally cleared. And if they do that, your refund will be blocked entirely.
All right, Section 3, the 9-month waiting game.
Timing your refund is notoriously misunderstood. And honestly, this is where the majority of directors get incredibly frustrated. Let's walk through a practical example to make this concrete. Meet Andrew, a UK company director.
His company's year-end is March 2026. He had an outstanding loan, and the S.455 tax was paid. Down the line, he manages to finally repay his loan in November 2027. Now, because November 2027 falls into his accounting year ending March 2028, the strict HMRC rules state he cannot reclaim the tax until 9 months and 1 day after that specific accounting period ends. So poor Andrew has to wait all the way until January 1st, 2029 to actually unlock his refund.
This example brilliantly illustrates why these refunds take so long. It feels really punitive, doesn't it? But HMRC does this deliberately. They mirror that original 9-month payment window to prevent abuse of the system. Think about it. Without this delay, a director could just repay a loan on Tuesday, claim their hefty refund on Wednesday, and then withdraw all the cash again on Thursday. The mandatory wait ensures the repayment is a genuine, permanent transaction.
Let's look at Section 4, submitting your reclaim form.
Once that mandatory and often quite lengthy waiting period has finally passed, it's time to submit the correct paperwork to HMRC. You can't just send them a polite letter and hope for the best. The specific form you use depends entirely on the calendar. If you are reclaiming the tax within 2 years of the end of the accounting period when the loan was originally taken out, you must amend your existing CT 600 return using the CT 600A supplementary pages. However, if more than 2 years have passed since that original period, you can no longer amend the return. Instead, you need to submit a specific standalone document known as Form L2P. You can do this either online or by post alongside your latest company tax return.
Filing this correctly requires absolute precision. You'll need your company's unique taxpayer reference, the exact dates the loan was drawn and repaid, and the corresponding accounting periods. And did you know that a huge number of refunds are severely delayed simply because HMRC holds outdated bank details? It happens all the time. Always verify HMRC has your current BACS details on file so the money actually hits your company account the moment it's approved.
Also, keep a very close eye on the calendar, because HMRC imposes a strict time limit on this. You only have exactly 4 years from the end of the accounting period in which the loan was repaid to claim your tax back. Let me be clear. If you miss this 4-year window, that temporary tax becomes a permanent loss to your business. You literally forfeit the money.
This brings us to our final part, Section 5, avoiding common tax pitfalls.
Knowing the rules is one thing, but navigating HMRC's anti-avoidance measures is another entirely. This leads us to the single most common question tax advisors hear on this topic. Can I just repay the loan right before my year end to avoid the 35.75% charge and then immediately withdraw it again a few days later? It sounds like a clever loophole, right? A quick fix. But I can assure you, HMRC is already a step ahead of this strategy.
They counter this so-called clever strategy with what is known as the 30-day bed and breakfasting rule. Here is how it works. If you repay £5,000 or more within 30 days before your year end, and then you reborrow money from the company within 30 days after, HMRC simply ignores the repayment entirely. They treat the original loan as still outstanding, and they will legally block your tax reclaim. They look very closely at the actual substance of the transaction, not just the dates on the bank transfers. Even when you do everything perfectly by the book, patience is definitely required. Here's another professional tip from Atlas Tax Advisors. HMRC processing delays are incredibly common when it comes to Section 455 refunds. You need to submit those amended returns meticulously to avoid getting stuck in the backlog. Ensuring your tax advisor has current 64.8 authorization in place and submitting absolutely pristine, error-free paperwork is really your best defense against getting stuck in a bureaucratic nightmare for months on end.
So let's quickly summarize the critical numbers you absolutely need to remember. For 2026-27, this temporary tax hits your cash flow at a punishing 35.75%. The refund only unlocks 9 months and 1 day after the end of the accounting period in which you actually clear the balance. And finally, you must claim it within a strict 4-year deadline while carefully navigating those 30-day anti-avoidance rules. Please remember that this explainer is for general guidance only. UK tax law is highly nuanced and things can change. You should always contact Atlas Tax Advisors for personalized, professional advice tailored specifically to your company's unique circumstances before making any financial decisions. So, looking at your own company accounts today, are you entirely sure your director's loan strategy isn't leaving a massive chunk of your working capital unnecessarily trapped with HMRC?